You have a S corp. Or no, you're the C corp.
Testing, testing. Can you hear me?
Yeah, I can hear you.
You're both Val has a C, yeah.
Yeah, she has a C corp. I have a best.
Yep. Elizabeth, I can hear you too.
The
I
pass.
can't hear you guys.
Okay.
Yeah.
I'm getting crushed with that.
Yeah, so let me talk.
Yeah.
That way everyone gets the benefit, but I'll talk about that. Yeah. Somebody talk online so I can make sure we can hear you.
We can hear you,
Unless-
or I can hear you anyway.
How's it going?
Can you hear me?
Good, thank you.
Okay.
I can hear you guys.
Watching Fire TV, Donnie.
Anyone in the room hear it?
What is the doc like?
Maybe not.
What doesn't he like to watch?
Yeah, Jim can hear you.
We're good.
Like Louis.
Huh?
He does like Louis.
Movies?
Can you hear us yet?
Oh,
Yeah, I can hear you now.
Yeah, yeah. Oh, yeah.
So I guess he was actually doing a the dude that.
Talk again, Kathy.
Can you hear me?
The dog that.
Yes, I can hear you.
Yeah.
Oh, Bluey is from Blue's Clues?
Yeah, I think so.
I didn't know
It's
that.
like a spin-off.
Oh, okay.
Maybe I made that up.
I'm really old now.
Want everyone out of the room, so it's just Zoom
Oh, God.
and that was all.
Hey, Kathy, do it again.
Kill me.
Can you hear me now?
Yes, thank you.
Your face is on there. People. Yeah.
All right, can you guys hear me okay online? All right.
Yeah, I hear you.
Give me just a minute. I want to get my camera up and going, and then we'll get started here. The game plan today, I don't think we're going to be here 2 hours. So number one, it's usually about an hour and a half. And we're going to talk about tax strategies as far as entities and cash flow and tax implications and all that. And then we'll also talk about expenses, what you can expense, what you can't expense. The corporate shareholders meeting in Cancun doesn't work. I know a lot of people still like to think that works. It doesn't. She's sending me a link.
I think she.
Okay. And if you have heard of any unique strategies, please bring it up and we can talk about the legitimacy of it. I will specifically address sub-S's, cash flows, and comparable wage. That's probably what you're running into from your CPA or accountant. You do need to take earned income as well as you have the opportunity for passive income if you meet certain criteria in the end. Nope, I still don't have it. Let's see here. Negatory. Did you send that? Okay. There we go. All right. Let me get online here. Join meeting. Open. Let's see. No audio. Oh, my battery's almost already dead. It's ridiculous. There isn't a way that you can get your battery fixed inside your laptop, is there? I don't think there is either. All right. Okay, so let's start with the different options that you have as far as how you're going to take the cash flow from your business, and then also discuss. Hey, Kathy, it's nice to see you. And when maybe you should think about making a change. So by default, everybody's a sole proprietor. you're independent. Let's talk. You're an independent contractor, right? You're not an employee of the brokerage firm. As an independent contractor, you have certain responsibilities, and you'll file your tax returns as a sole proprietor. As a sole proprietor and as an independent contractor, not having a company name, and I'll talk about having a company name and still being a sole proprietor. You have certain tax obligations, and including we'll have to issue a 1099. You should get that every year. You can download it through Command, I believe, because they are sunsetting mykw.kw.com. So that's getting sunsetted. Typically what I tell people is when you get to about net, not gross, but net 80 to 100,000, that's probably about the right time to start really considering a alternative entity versus being a sole proprietor. And we'll talk about the pros and cons of sole proprietor. Now, I do know Jim's on this call, and Jim, I believe, continues to be a sole proprietor and not have an entity, which is totally, I have people that make 2, 3, 400,000 and continue to be a sole proprietor because there are pros to being a sole proprietor. The pros of a sole proprietor is simple. You can commingle your funds. You still get the QBID. You actually get a larger qualified business income deduction than you do if you're sub S, because the whole amount is considered earned income and profit, and you get to take the 20% deduction off. So if you net 100,000 as a sole proprietor, you get a $20,000 tax free from federal and state income taxes. So that is definitely a plus. The negative is that the sole proprietor is the highest risk of audit. And if we were talking like 4 years ago, 3 years ago, when Biden passed his IRS budget, he put in something like $70 billion increase to the IRS budget. And they were looking at hiring like 75,000 new agents. And they wanted to start really going after unreported income and overreported expenses. I will tell you that if you go all the way back to Bush 1, every administration, both Democrat and Republican, have carved more and more. They have reduced the budget for the IRS every year until Biden. Biden was the first one that did it. Well, he carved it back. So that risk isn't as great as it sounds. They pulled back a lot of the increase to the budget because they were having some other issues that they needed money for. And so the risk is still about the same. The reason that there's risk with sole proprietor is everyone knows that there's typically a cash discount available when you're dealing with like an independent electrician, plumber, et cetera. What do you think the odds are that money is or isn't reported since it's cash, right? And the government knows, right? The government knows. So you're put into this and the other thing that they'll do is they'll do ratios. So like when you fill out a sole proprietor or Schedule C, you have to put what the business is. And then they have ratios that they look at, like let's say you're in construction. They have ratios that they look at that your materials should fall into based on a percentage of the sales that you're showing. And if your percentage is, let's just for argument's sake, let's say they're expecting materials to be 25 to 28, 25 to 30% of your total sales. And if your actual materials turns out to be 50 to 60%, you're underreporting your sales, right? Or you're overreporting your materials. And so you stand the potential of getting an audit. By the way, everybody in here, everybody online, all of you have had an audit in the past. Every one of you have. If you received a notice in the mail that said, we corrected your tax return, that was an audit. Like you left interest income off, that was an audit. You didn't report a 1099 that you forgot about, that was an audit, okay? And then they correct your return for you. That's called a mail audit. The next level up is where they send out a letter to you that says, hey, we're questioning your material expenses. Please provide the receipts. And so you send in the receipts, or you make an appointment and you go into the office to show them your receipts. That's an office audit. The one you never, ever, ever want to get is when they come out to your house to audit. So what they're doing in that situation is they feel like they've got you. And the other reason that they're coming out is they're doing what's called a reverse audit. And the reverse audit is they're looking at your lifestyle in comparison to the income you're reporting. And so if there's a BMW or a Jag parked, and there's a big boat and an RV and everything else, and your income level doesn't warrant that, they're going to start, instead of asking about your income, they're going to start asking for receipts of the things that you own. So do you want to share any of that experience?
Yeah, so it was, my husband was in patent sales at the time. And I was doing books, which is laughable. So this woman comes to the door at 8 a.m. and she's carrying a bag. And my husband's like, what is, oh, she says, do you have a fridge? And he said, what?
Oh yeah, they're going to be there all day.
That's my lunch. He goes, what? And she was there all day. I was running up and down the stairs, getting all of the documentation. And it came out that we were $29 short for it.
That's a good feeling.
That was great. Yeah, it was good to be vindicated, but I was just, oh, yeah, I want to kill her at the end of the day.
So I also had that, only mine lasted more than one day, and it was over 3 years.
So many agents.
Kimberly, can you mute yourself, please? Getting background, thanks. And so what happened is back in the day, CPAs, doctors, lawyers that were independent contractors, there was a tax strategy that we utilized that got shut down, and that was we had sub S's as our corporations, and let's say you netted 100,000, you would take $99,900 as profit, and you take $100 wage. Okay, and so they shut that loophole down. So today, if you have a sub S, in order to, and by the way, we have like the greatest lobby through NAR called RPAC, and there were only 2 service industries that was allowed to get the qualified business income deduction. It was us, and do you know who the other service industry was? It wasn't attorneys. It was architects. So apparently architects have a great lobbyist. But we're the only real estate is one of only 2 service industries in which we're allowed to get the qualified business income deduction. Do you know what the qualified business income deduction is? Okay. So your net profit, you receive 20% deduction off of that. And it's 20% that you don't have to pay state or federal taxes. Okay, and that was set to expire in 2027, but this last tax legislation that was passed made it permanent. So now that 20% is permanent. Now the only way it can go away is not by the stroke of a pen by a president. It would have to be voted on by both the Senate and the House. Okay, so that's permanent. The bad news is that the good news is they increased the SALT, which is the state and local tax deduction. It has been limited to 10,000 for the last 4 years. They increased it to 40,000, but it goes away in 2029. It goes back to 10,000 in 2029 unless Senate and Congress will pass that and make it permanent. So that was part of the compromise that was made in order to get the bill out that we currently have. Question? It'll go back to the 10, unless they can pass it to make it 40 and make it permanent. That'll have to be the Senate and the House. Most of the time, and this has been going on for about 16 years now. For the last 16 years, tax legislation typically is being passed very late in the game, if not retroactively. So like it doesn't get passed till January. So it makes it really hard to strategize and plan when you find out that SALT is passed in January. You might have done something differently in December as part of your tax strategy. It has gotten a little bit better. They're at least passing it in November, October, November, December this year. And we haven't had too much go into January, but every year there's things sunsetting, expiring, or being continued. And again, it's usually pretty late in the year when they make that decision as to what's going to happen and they vote on it. This year it's been pretty good. We had a pretty good idea ahead of time and we could plan for it. So for example, when I say plan for it, before this last legislation that went through, most people were taking the standard deduction because it was so high versus taking itemized deductions. About the only way you're going to itemize is if you're a big giver, and so you have a lot of charity deductions. So one tax strategy, if you knew the tax law was going to be what it is instead of donating every year, you donate once every 2 years. And so you have a much bigger tax deduction, and then you get to itemize that year. So you alternate between itemizing and standard deduction. That would be a tax strategy, what I'm talking about when you're doing this. So back to the entities. In order to do, well, let's go back to pros and cons. Pro is you're doing a lot less tax forms. It's going to cost you less to have an accountant do your tax return. You can do the bag of receipts that you used to see on, what was the show? Seinfeld. And, throw it out there. Not that most accountants are going to do that for you. They're going to make you do it. But it's just a very simplified, easy process to do commingle funds, all that. If you're going to set up an entity, and you can still set up an entity, it's called, let's say you set up an LLC. It can be a disregarded entity. So you're just strictly doing it for legal reasons. You're trying to give yourself some protection against potential lawsuits and your personal assets. I will recommend that if you do have a lot of personal assets, you do look into a trust strategy with an estate planner, okay? And nothing right away. I mean, I didn't do mine until I was in my late 40s, early 50s. But at some point, you may want to consider, especially if you start getting rental properties and other assets. Okay. You will pay the highest amount of taxes as a sole proprietor overall, as you get into the higher levels of income. I would say if you're netting 50,000, 60,000, it's not worth it. But when you're starting to net 80, 100,000, 120,000 after your expenses, it starts to get to be worthwhile. And I'll run through some general numbers for you later. As a sub S, and this is what we're getting into for you, or a C Corp, which honestly, very few people, it makes sense to have a C Corp. You can write your medical insurance off on the front page of your 1040. So now you're just talking out of cost medical costs, like whatever your deductible is, whatever's not covered by your insurance. In my case, we have two companies. One is the sub S, where we maximize profitability. The C Corp basically breaks even, has a very small wage, but it's about the employee benefits, the married couple employee benefits. And that's just the out-of-pocket costs at that point. One way to get around that, if you're a sole proprietor, or you don't have that luxury where both of you are independent contractors and you can do that, is utilizing the HSAs, okay? And you have to have a high deductible, which most of us have, health insurance. And then you can put up to, I don't know, $6,500, $7,500 if it's a family plan in there, tax-free. And then if you do have deductibles, that can come out of there. I do recommend that if you do an HSA, that you don't take the money yourself like a reimbursement plan, that you pay directly. Because the IRS will be notified however much money came out. If it's and they check a box if they paid you and not directly to a provider. Question? Are you talking about like a 401k?
Yeah.
Yeah, the HSA is in your name. Yeah, you're just, now it'd be up to you to fund it if you wanted to fund it. Before they were probably funding it or splitting it with you to fund it. Now it'd be up to you to fund it. Yeah. Otherwise, if you have $10,000 in there and you have a medical issue come up, you can pay for it out of there. Again, I would recommend directly, but if you do reimburse yourself, there's still a way to show that on the tax return. It's not a big deal, but that'll be tax free. And that's accomplishing the same thing that a C Corp does. So you could be a sub S and then individually do an HSA, and that'll accomplish the same thing. You can't. So with the sub S, I will pay my retirement SEP and I will pay my, I don't pay my insurance out of there. But if I did, it would be not deductible on the sub S. It would flow through on the K1 and the deduction would show up on your personal tax return. The plus on that is that you're minimizing how much you're paying Social Security, whether you believe you're going to have it or not down the road. That's a whole different deal. So with the sub S, so I'm not going to, does anybody need me to talk about the C Corp? I really think it's a waste of time. Okay. Years ago, it was worthwhile, but today it's not. So with the sub S, when you get to, and there's no definitive dollar amount, I'm just giving you kind of a ballpark when it kind of makes sense. There are 4 rules that you have to follow in order to correctly take profitability out of a sub S. And so this is getting down to the cash flow. With my tax strategy, we have a C Corp, which is for employee benefits. We have a sub S Corp, which maximizes real estate income and other pass-through entities that I have. So it's like a parent company. So I'm sorry, that's not probably the right way to look at it. It's where my investments in other companies, the dividends would flow to, and then they flow down to me. And so I'll have high pass-through dollars coming through that company. There's no hard and set number when I tell you the 4 rules. The 4 rules are: 1, you got to be able to justify profit. Okay, well the government took care of that for us because that's how we get a QBID is off of profit. So 1, we can justify profit. 2, you have to take what's called a comparable wage, and a comparable wage is not defined in the IRS code. It is, and the best way I can define it for you is, what would you have to pay somebody else to do what you did to earn that money? That's a comparable wage. So typically, and I don't know if this came up on your audit or not, but one of the things that one of the questions an auditor will ask, and this is why Cancun trips are not deductible, is how many hours do you spend in the business a week? Give me a number. Right, that's typical. How many hours do you spend in the business? Okay, that's untypical. How many hours do you spend in the business? Okay, that's really untypical. So most people will say 60, 70 hours. And so then the auditor goes, great. So when you went to Cancun, how many hours did you spend in your meeting? 3. Great. You can write off 3/70ths of this trip. That's it. Right? So that's the common answer, is that you're spending a lot of time. The right answer is 30 to 40 hours. You know, you don't want to, even though you may spend 60, 70, 80 hours, it feels like 80 sometimes, you actually want to go with a more realistic number, because they're going to use that for prorations of different things that may be coming up. Yep. So, and that comes down to, what would you have to pay somebody else to do what you're doing? If you have 70 hours, now you got to pay somebody 70 hours at 25, 30 bucks, whatever the hourly compensation should be. And now all of a sudden your wage is way up there. If you're 30, now it's not nearly as much, half what you said, right? In order to justify that. I will say that initially, until you get into higher level incomes, let's say you have a net of 100,000, you really should be taking 2/3 wage, 1/3 profit. You get up to like 150, 160,000, maybe you can justify 50/50 or 60/40, 60 wage, 40% salary. I had a broker that's going to net 600,000, and she wanted to do, FICA tax being withheld, I think drops out at 160 or somewhere around there. And then it's just Medicare at that point. And you have different, and so this is going to come back to why are we struggling with this? It depends on your CPA. It depends on your accountant. Like the one, and they're actually in my Evergreen office building. They're like, no, you need to take 500,000 of that as wage and only take 100,000 of profit. And you can see how that kills her, because honestly, she could have paid somebody $175,000 to do what she did, and everything else was profit. And I think that's very justifiable. Well, now think about the QBID. You know, QBID, 400,000 QBID, that's $80,000 you don't have to pay tax on. At 100,000, it's only 20,000 that you're not paying tax on. So I do think that there's different levels that CPAs fall into. And I'll say everything from lily white to, hey, you can't take any profit at all, to black, $100 wage. Okay, we're not doing that. I like to live in the world of gray. I want to maximize what we can deduct. And by the way, we're minimizing our tax liability. We're not avoiding tax liability. Avoiding taxes is against the law. You can go to jail for that. But we do want to minimize our tax liability based on legitimate tax strategies that are available to us. So as your income goes up, I can see that percentage from 1/3, 2/3, or 2/3, 1/3, coming closer to 50-50 to a point where it exceeds. So for example, with myself, since I have dividends coming in, which is passive income from other entities, my wage is substantially less than what my profitability is that I'm passing through. But I also know I can defend that too, based on the hours that I physically worked versus the profit that was coming in off of market centers and other sources. Does that make sense? Mm-hmm.
Like a W-2.
So one of the negatives to a sub S or a C corp is, unlike a sole proprietor, I can't commingle funds. Separate business account, and not even as a sole proprietor, I'd highly encourage you to keep separate accounts and get used to doing that, because the IRS does allow you to retroactively set up an entity. But it's also going to be based on how you ran it. So if you commingled your funds, you can set up retroactively a sub S, but now the character of the sub S is not substantiated by how you ran it. If you have separate accounts and you ran your business expense, your business income and business expenses out of the business account, and then you just took a draw over, like a contractor draw over to your personal account, and all of a sudden you hit a home run toward the end of the year, and you thought you were going to make $60,000. Instead, you made $260,000, and you're like, you talk to your accountant, and your accountant's like, yeah, you're going to owe $110,000 in taxes. Well, what can I do? You could set up a sub S retroactively, take a wage, and you take it all at the end of the year, recognize it, and take profitability and be able to get that QBID. Does that make sense? And that's a thing that changed. You used to not be able to do that. It used to be you had to set up your entity by March 15th of the tax year, not the next year. Now you can actually, I was actually switching some things up, and I did it like in April for that coming year. They retroactively set it up for the previous year. I had to get it fixed, because they just assumed that I wanted it for the previous year, not the current year. So ever since they passed it, that made our lives a lot easier, because before, who knows in January what you're going to make for the year as a realtor, right? I mean, your pipeline's good for 3 months, but it ain't good for 12 months. So if you're sitting there on the bubble thinking, well, I don't know what I'm going to do, stay as a sole proprietor. And then if you do hit a home run, you can always retroactively go back and fix it. So back to CPAs. So I was out of town at the time that this broker contacted me, and I gave her the same story. I said, look, you have to respect, because that CPA may be called to defend the tax strategy that you're using. I said, check around. There are other CPAs out there that are going to understand and recognize and be able to defend the position you're taking, and honestly, she may be closer to $1 million. It's just been a crazy year for her. You're going to find somebody who's going to be like, yeah, you could take $250,000 in wage and $750,000 in a profit. Okay. But they have to feel comfortable they can defend it. So with your accountant or CPA, what are you running into? Lily white. So they're saying you can't take any dividends at all.
I mean, I do.
Mhm.
But, yeah, no, my pass-through, the pass-through.
You can go
amount
with percentages.
is like 50,
50?
50 on top of.
Well, that's not bad.
On top of my, what I pay myself.
Okay, so think of it as in gross. Okay. If you made net 100,000, are you saying you're taking 50 in wage and 50 in dividends?
Oh, no.
What do you, that's what I'm saying. Use 100,000 as an example. What portion of that are you taking in wage and what portion of that are you taking in dividends?
It's probably 50.
That's actually fairly aggressive. Unless you're talking about $500,000. If you're talking about 200,000, that's actually aggressive. At 200,000, I don't think I would do 50-50. I'd probably do 120 and 80 is what I would do on my personal tax return, much less somebody else's. So that's not bad. I mean, Lily White would have been 90 and 10. That would be bad. That would be hard on you as a taxpayer. So no, I think your accountant, or is it a CPA or accountant? Okay, I think that person is actually aggressive. Honestly, again, unless we're talking 600,000. Now I don't think I would take a $300,000 wage and 300,000 in dividend. I would do something like 175 and whatever the difference is. Make sense? Okay. Yeah. So now you can feel better about, you can stop hating on that CPA. Now the one I'm talking about, they were talking about like 10% could be profit and the rest was going to be wages. And here's the ironic thing: the difference is from a tax standpoint is insubstantial. It's like 3.8% of whatever that number is. It's the QBID that they were crushing the soul out of this person. Because you're talking, 600,000 at 20%, now you don't get that tax-free income. So that's what, that was the one that was tough in the end. So she found, by the way, within 3 weeks, she found a different CPA that had a very similar take on the tax law as I did. So, and I had one, Sally Ball had her accountant said you couldn't take anything because you're service oriented. Because what are you profiting on? That was the argument before Congress acknowledged that we can justify a profit. What are you selling that you're profiting on? Right? We're service oriented. Well, my argument is no, we're commission based, and I am selling a product. I just don't own the product. And guess what? IRS saw that, and well, Congress saw it. Now the IRS has no choice but to see it. So we could justify it. But the one Sally talked to before this law passed, or the tax legislation 5 years ago, would not do it at all. And I said, well, just go find somebody else. That's okay. That doesn't mean they're a bad person. It just means that they're not the right person to do your tax returns. That's all. And for those of you online, if you do have a question, just interject at any time. It's fine. So the negatives to an entity that's not disregarded. So I'm not talking about, an LLC disregarding your sole proprietor, but a sub S is you are going to have a lot more complexity. You can't commingle funds, separate accounts. You're going to have quarterly tax forms that you got to send in. That's a 941 and a state unemployment form. On an annual basis, you're going to have to issue W-2s and W-3s and a 940. So there's a lot more complexity to it. And one of two things is going to happen. Either you like complexity or you're going to go hire somebody that can handle the complexity. Well, guess what? That's going to cost. Okay, so where if you were Jim, maybe Jim's tax bill, to pay somebody is $1,000. Yours might be $3,000. Okay, because you got a corporate tax return, you got a state corporate tax return. You're going to have K-1s that are going to flow down to your personal tax return. Now you got your personal tax return. You got all your payroll forms. By the way, 1099s. I don't know if I talked about this before or not, but right now the tax law is if you pay somebody $600 or more and they're not an entity, they're not a company, they're not a sub S, a C corp, a partnership, something, you have to issue a 1099 and a 1099 and a Form 1096, which is the summation of all your 1099s, a copy of the 1099 and 1096 gets sent into the IRS, and then you're to give the 1099 to the sole proprietor. Part of what you have to gather is their social security number and their address. So if you hire somebody, a photographer, a stager, one of the questions you need to ask them is, or have them fill out, is a W-9. And you can get that off of irs.gov. And a W-9 states to you whether they're a sole proprietor or not. And it's they're either going to fill in a social security number or an EIN number, which is an employer identification number. If they have an EIN number, typically, not always, but 90% of the time, that means they're not a sole proprietor. Okay, they're a company. And usually a company will be followed by an LLC, INC, partnership, limited, something that will tell you that they're a company. Okay.
I have a question.
Yeah, go ahead.
Can you talk about the crazy state of Colorado requirements for issuing a 1099 to a sole proprietor?
Elaborate, because I'm not aware of any crazy thing.
They state, and it's different for the state of Colorado than it is for the IRS,
Okay.
that I need to get my sole proprietor, well, that's how I summarized what I read. I need to
Okay.
form an LLC in
You
order
have
to
to.
submit to them a 1099.
They're saying you have to form your own LLC in order to submit a 1099?
That my cleaner should.
No.
It's
Send me that documentation, because I've never heard of that. So send it to me and I'll take a look at it.
okay.
Because we can't require somebody to become an LLC in order to 1099. As a matter of fact, by them becoming an LLC, we don't have to 1099. So that requirement then would be gone. I will say this, that it used to be, it was like $10 per form if you didn't do it, and then it went to 20. It's now 200. So for every 1099 you don't issue, it's $200 fine. Now, hi, my name's Kevin. I live in the gray, and I have like 3 people I should 1099, and I typically don't. Okay. So what's the consequence to that?
Why don't you?
I just don't do it. Don't feel like it. And so what's the consequence? If I'm audited, I'm wrong. I will be punitively punished at $200 a pop for each and every one of them. And I can live with that. So you have to be willing to live with whatever the consequence is. I'm not encouraging any of you to do that. I'm just saying that I'll give you another example. My cell phone. I have one phone. I write it off 100%. Is my cell phone really 100% write-off? No. How much do you think your phone should be?
50.
Yeah, I'd say 50 is pretty reasonable, right? Again, you got to be willing to live with the consequence. And I'm not a sole proprietor, but most sole proprietors' tax returns look like that. I'm serious. They look like that. And so and the IRS is aware of that, and they're going to pick up some expenses, or they're going to pick up some income, and they're going to get some tax. I'm okay with that. Right? Yeah. So, all right. So 1099s, everybody's clear. So 600 or more. Correct. And that's annual.
Yeah.
But you got to get that information up front, because if you don't get the information up front, you're not going to know. And let me tell you, you stop working with that person and then you try to get their information, you ain't getting squat from them. Yeah.
Yeah, that's contractors, then if you don't get the W-9 while you go, they're like, no.
Yeah, they're not going to give you their social. They never will send it to you. Yep, exactly. So you want to get that W-9 filled out up front. And like I said, the people we're using, for the most part, are not going to be sole proprietors, for the most part. I said 3. I think I really only had 1, and that was Mark Feldman, who retired. And he was a photographer. Correct. Yeah. If they're a company with an EIN number, we're not required to 1099 companies. Now, that brings me, I said something happened about 8 years ago. And that something is that there was a senator or a representative out of, I believe it was Oklahoma, that they were going to pass a bill that said you have to 1099 every single person and entity that you paid $600 to or more. Now, I want you to think about this for a second. You get your gas at Sinclair in Conifer, and then you fill up with gas at Sinclair in Lakewood. Those are two different companies. Home Depots. Now, Home Depot might be one, but you are going to have to somehow figure out how to 1099 everything you spent money on over $600. So that person, I think it was out of the House of Representatives, went back to Oklahoma, and that person was tarred and feathered and sent back to Washington, D.C., and they squashed the bill. Now, there is one now. Everybody likes to, I think, Venmo and Zelle and all that stuff. So they're putting this requirement on. So this is a new tax law that came out just recently, is if you take, and I think it's the combination of both, if you take $20,000 and 200 transactions, you will have to be 1099'd. You will have to report that. So they're
Any income that.
well, you should. What I'm saying is now it's going to be sent to the IRS, and they're going to be looking for it. No, it's not required yet. Right now, so anytime. So here's another thing that allows sole proprietors to kind of get away with things is if you're receiving Zelle payments, how often is that? Hey, I'm going to reimburse you for the dinner we split, and you paid, but I owe you. I'm going to reimburse you, whatever. It's a lot of times reimbursement, but it's also a lot of times a mechanic working on the side doing a job, right? And so I believe, and I don't do Zelle, I don't do Venmo, Val does all that. I believe you could check a box whether it's business or personal, right? Well, could you please check personal for me, right? And so they're aware of that. So at first, what they wanted to pass is all of these Zelle, Venmo, what else is out there, PayPal, whatever they are, they're going to require all of them, whatever you took in, to be 1099. And instead, they compromise, and the compromise is if you take in 20,000 and 200 transactions, it could be or, then you're going to get 1099 by that company. Now, I'm not aware of any companies 1099, because if you get 1099 by a company, they're required to send you a copy of the 1099 also. Did you ever get a copy of 1099 from Zelle or Venmo?
Yeah.
Right. Now, if you were taking credit cards, they have been. So if you receive credit card payments in your business, you'll actually receive a 1099, and it's called 1099K or something, and it will show monthly what income that you had, and you gotta show it, and then if some of it was personal, then you deduct the personal off of it. So that's out there. That's the thing. But I can tell you that's just the first whack at the ball there. They're going to come after it again and again and again because they know it's a mechanism that people are hiding income. I get it. I totally get it. So I don't care whether you get 1099 or not. You need to report all of your income, period. Okay? I just know it's going to be challenging for a lot of people that if they pass where you're going to get 1099 for everything, they're going to be on the struggle bus trying to figure out how to separate out what was really income, what was really business. Well, then that's where you have two separate accounts. That's the way. That's keeping that commingling from occurring. Does that make sense? All right. So back to sub S. The four criteria is comparable wage, which we talked about. What would you have to pay somebody else to do what you're doing? 2, justification of a dividend. We've been justified. 3, you cannot borrow against a dividend, and you can't take it monthly. You have to take it quarterly, semi-annually, or annually. So like when they started changing these rules, like in the beginning, we go, okay, well, we're taking our dividends monthly. And then it was, okay, we're going to borrow money and then we'll pay our dividend quarterly and then pay the loan back. All of those loopholes are gone. So and they shut them down hard. Questions on that part? Okay, so sub S. So let's talk about LLCs briefly and then sub S's. Most people don't think of setting up a company as a sub S or a C corp or a partnership. Everybody talks about what? LLCs. Okay, well, the federal government does not recognize LLCs. LLCs do not exist as far as the federal government is concerned. So what ends up happening, and it's fine. I've got LLCs, and then I have C corps, and I have sub S. I have partnerships. Well, here's what ends up happening. You can do an LLC. That's perfectly fine. But you have to notify the IRS how you want to be taxed. So you could do an LLC as a sole proprietor, which is a disregarded entity. You don't have a separate tax return you're going to do. You're just going to do it on your personal tax return, which is fine because there is some legal, a little bit, not much, but some legal shielding that occurs. So there's a reason why people will set up an LLC and then still be taxed as a sole proprietor. Most people are setting up an LLC, and then you have to fill out a separate form for the IRS because the LLC paperwork is done here locally in the state of Colorado or Delaware or wherever you're setting up your LLC. But for our purpose of our discussion, you're setting it up here. Okay, so you set it up with Colorado Secretary of State. After you set it up, you have to follow up with a separate form to the IRS that says, hey, I've set up this entity and here's how I'm going to be taxed, sub S. Okay, and you're going to do a sub S. Actually, sub S is a little more complicated than that. All companies are initially a corporation. In order to become a sub S, you actually have to do an election. And the reason they make you do that is you set your company up as a C corp, then you make an election to be a sub S. One time you can go from a sub S back to a C corp, and then you can never change it again. Okay, so you actually file two forms in order to become a sub S. You file a form stating that you're an entity and that you're going to be a sub S, and then you elect to become the sub S. Does that make sense? So it's complicated, and again, that's why you're going to pay somebody most likely to handle that stuff for you. And by the way, I hired an attorney to set up the company that owns this building here, and they didn't frickin' file the sub S. No, I'm not. And luckily, I knew what to do to fix it, but it took 4 months to get it fixed. So and how I found out was I went to file the first tax return, and I always file an extension. I mean, I'll do my taxes in January typically, but I always file extensions. I come from that group of CPAs and accountants and so forth that really believe that the majority of the group that gets audited are the ones that file on time. And if you do an extension, you don't have to go to the full limited extension, but you get past that, you have less of a chance. Not saying there isn't a chance, but it's less of a chance. And so when I went to file my extension, I was denied. And it said, you're a C corp. And we were supposed to be a partnership. No, we were supposed to be a sub S. And so I had to file a retroactive, just like I talked about, filed that, and it took 4 months, but it got approved. So in the end, it wasn't a problem. And then if you don't file on time, it's a $100 penalty per day per shareholder. But there is a way to get out of that, and we did, because I had filed 6 months late, or I filed 4 months late. So do the math on that. Yeah. All right. Any questions on entities? Anybody having issues with entity or discussion around an entity?
Well, I have a question for LLCs then. There really is no tax benefits. It's just liability. Is that what you're saying there?
If you're a disregarded entity, there's definitely tax benefits also with the entity. So for example, a tax benefit that an LLC had, I'm sorry, not an LLC, sub S. Everything's LLC, but how it's taxed as a sub S is I can write off, let's say your wage is going to be $100,000. Your self-employment tax is going to be $15,300. Half of that I can write off on my sub S. That $7,650 I can write off on my sub S. Let's say you're going to take $25,000 as a SEP. I can pay for that out of the company. I can't deduct it out of the company, but I just saved 7.65% on that $25,000. Whereas as a sole proprietor, you put $25,000 in, you're taking it out of that income you already paid the $15,300 on. So there's definitely tax savings through the sub S. It's not as great as it was when we could write all of our medical and health insurance off on the C corp, but they changed the tax laws of individuals so that you don't have to go that route with the C corp. With the C corp, because I used the C corp strategy for decades. You always had to drain the company down to zero, so you'd have to make sure at the end of the year you wiped it out with wage or bonus or whatever you want to call it. Because if you left profit in a C corp, you're going to pay corporate tax, and then later when you finally do take that income over to yourself personally, you're going to pay individual tax. That's the double taxation you hear about. With the sub S, you don't. The sub S does not pay tax at the corporate level. Now there is a negative that you have to be careful of. You can't run a loss. You cannot write a loss off from a sub S that is below what your basis is. So in other words, let's say you set up a company, you put $10,000 into it to get it started. Your basis is $10,000. Now every year, the profit will be added to that basis, and then whatever you pay yourself out in dividends will be subtracted from that basis. You can never get below zero. Now, you can, there is a way. You can, but you can't write it off anymore. We used to be able to write it off. And so that became a tax strategy. I didn't support this tax strategy where people would run up debt. So like a company, they'd have a sub S, they would go out and borrow, not personally, but through the company, and then bankrupt the company and get rid of it. And they wrote the losses off. So they got all the benefits of this losses. You see where I'm going with this? So now you can't do that. That loophole has been closed up. Now, if you personally guaranteed the loan, you got basis, right? So that loan is now your loan. But they weren't doing that. They were actually running up debt and then reneging on the debt, no personal guarantees, nothing for the companies to come after, and they received tax benefit from it. So the IRS said, nope, we're done with this. We're done with this crap. And so now you actually have to track your base. Every shareholder's basis has to be tracked. Again, this is what the accountants do. This is what we do. You have to track every single shareholder's or partner's basis on the business tax return, and you're required to track your basis on your individual tax return. And those are worksheet forms that you don't really see. They're kind of behind the scenes. But that's to prevent that little tax strategy. And it's one thing that you borrowed $10,000, you're no longer in business, you got disabled or whatever, and you shut down the business. I'm talking about hundreds of thousands of dollars that people wrote off. Yeah, it's amazing how creative people can be. Did that answer your question, Jim?
Oh yeah, I always thought that attorneys will say, "Oh, get an LLC because you have less liability. That's why you should do it." But
so let me say something to that. Yes and no. Technically, yes. I do believe that there is a thin veil for you. And yes, there's a huge ironclad shield wall that protects others that might be in your business. Meaning, an LLC does not. So an LLC was actually created because the partnership wasn't doing its job. It wasn't helping the partners out like they thought it would. Because in a partnership, you have general partners and you have limited partners. And the problem is the language the IRS had federally didn't really protect the limited partners like they wanted it to. So a number of states, and by the way, their LLCs are not in every single state. They are in the majority of states, but they're not in every single state. We have had it for probably since the 70s, maybe the 80s. And an LLC was like, we got to come up with something stronger. Because let's say you have a great idea. No, I have a great idea. I have a great idea. And you crushed it in football. And so you're this multi-millionaire. But we were buds in school. And I go, hey, I got this great idea. There's an abandoned mall over in Westminster. And I would like to set up, you know how you do paintball stuff? I'd like to do it with real guns. Okay? So I'd like you to invest $10 million into my company. I'll handle everything else. Okay, I'll get all the weapons and everything. we're going to draw the line at hand grenades, but otherwise live. Okay. We'll do body armor. Okay. And somebody gets killed. God, can you believe that? Somebody died. And what do you think they're going to do? Oh, they darn right they're going to sue. So now they sue the company. You, as a member, so LLCs don't have partners, general, and limited. What we have is managing members, that's me, and members, which is you. Your identity can even be hid in an LLC. However, managing members, we're at the front of the boat. We're going to take the spears, we're going to take the shots. So, Jim, to answer your question, it can protect members, but a managing member can take the bullet. And so that's where, when you have a disregarded entity and it's only one person in the entity, that's got to be a managing member. So it's much more limited. That legal protection is much more limited in that scenario. But by the way, sub S, same thing. C Corp, same thing. So it's not like you're losing or gaining anything. It's just limited. My recommendation, don't be negligent and don't do any fraud or constructive fraud. Okay, that can pierce that legal protection for you. So yes, it does protect. It does provide some, and it's better than being a sole proprietor, but it's not perfect by any stretch.
Yeah, well, I haven't any trouble being a sole proprietor, and as long as you have a profit in the real estate business, you take that 20% business deduction.
Sure.
Really pretty good thing there. And decrease your liability, get an umbrella policy.
Yep.
That's probably the best thing you could do is just, for people who don't know, get an umbrella policy to protect you for additional amounts if you get sued.
Well, I think the umbrella, okay, so yes and no. If you get sued on your real estate business, it's not going to help you, but on your rentals, on your investment properties, yes. I have a nice $2 million umbrella policy for that. So, yep, exactly.
I even had a client use an umbrella policy. He was sued when he sold his house because they said he had structural defects or something. He told me, my insurance company, since I had an umbrella policy, they're going to defend me, he said. I didn't realize that could happen.
Well, not only that, but like I had horses at one time. I have a boat. That will cover that as well. You have a boating accident, an umbrella policy will kick in there too. It's just not going to kick in for your business income. It's not going to kick in for that.
And you could deduct it on your taxes, that umbrella policy amount.
I haven't done that.
I do.
I haven't done that. You might check on that.
Oh no, it's insurance that you're buying, and I
Well, but you don't get to write off your homeowner's insurance, so you can write off your rentals insurance. Oh, you know what? I could see that. If you have investment properties, yes, I could see splitting them out amongst their investments. Thank you, Jim. I have a new deduction.
Yeah. Well, especially when you get up there.
Oh, my umbrella policy, I believe, is around $3,000.
Yeah.
So yes.
Yeah, mine's about almost 3,000.
See, I am still learning. And I take 80 hours every year of additional education on taxes. My master's degree is in taxation, and I missed that one. Good job. Appreciate you. All right. Got to own it when you miss it. All right. Let's see. Any other questions on entities? All right. Let's talk about deductions. I am not going to waste your time talking about the obvious. Can I write off my MLS dues? Of course you can write off your MLS dues. Can I write off paying an accountant? Yes, you can write off paying an accountant. Can I write off clothing? Only if it's branded. You brand it, you can write it off. Otherwise, you can't write it off. Okay? Now, let's say you're in construction and you have to buy specific work boots for what you're doing. Yes, you could write that off. But in our real estate industry, it's got to be branded. So I have more vests and coats and shirts and you name it that has KW on it. Okay? And it's not like the real estate commission. It doesn't have to say Keller Williams Avenues LLC. No. KW is perfectly fine. You don't have to get elaborate. Can I write off the trip to Cancun? Have I pretty much answered that question now? Okay. It's not worth it. Now, however, I have written off many a trip that was proportioned based on a business trip. So we go to family reunion. We go to Orlando, or we go to California. So I had to fly out there, business. I had to fly back, business. But I decided to stay 3 extra days. The hotels for that 3 extra days, no. But my flights are still deductible. So you can piggyback and make it worthwhile. You could go fly into California, still got to fly back, fly to Cancun. The Cancun flight is not deductible. Fly back home. As long as this flight back home does not exceed what it would have cost to fly back from California, you can do that. And by the way, most trips from Mexico are cheaper than flying domestically. Oh, it's crazy. It's crazy. So you can get creative from that standpoint. If you rented a car, you just got to prorate the rental of the car. What portion was business? What portion was personal? Right? By the way, how many hours do you work a day? Right? If you're a 10-hour workday, you may not even be able to write off your conference completely. But if you're not, 6 to 8 hours a day, no problem. Right? No problem. Right? Travel food until you're on your personal part of it. Make sense? So we do that a lot on family reunion trips. We will do that quite frequently. So who does not have a home office? Okay, you have a home office. It is critical that you have a home office. Now, it can't be the dining room table, okay? But it can be a shared room. A loft area would be great. That's where mine is. Here's the deal. It's not about the home office write-off. It's about your vehicle. If you don't have a home office, then when you leave your house to go do something, that's commuting. You cannot deduct commuting. If you have and by the way, you can have more than one office. I have multiple offices, but I have a home office. And my home office is 6 by 4. No, it's probably 5. 5 by 4, because the chair's got to back up. Okay, so 5 by 4 is 20 square feet. My house is 4,000 square feet. So I'm writing off what? 0.05% of my utilities, all this other stuff, right? Interest, only the interest. But it's meaningless. You see what I'm saying? It's $100 a year, whatever it is. It's nothing. It's not about the home office. It's about your vehicle. You want to have a greater business use of your vehicle, and commuting miles are not deductible. Now, that brings us to vehicle. So you have 2 options. Okay, one is you got to keep track of miles no matter what you do. You can either write off a per diem for miles, and I want to say I think it's 70 cents now a mile. It's a pretty high number. Yeah, I think it's 70 cents a mile, or actual expenses based on business use. So that comes back to your question. I have 2, I'm sorry, yes, I have 1 full-time business use vehicle for my S Corp. We have 1 full-time business use for the C Corp. We have 3 personal vehicles that we can utilize. And they're just backup vehicles, honestly. And so again, this is where, remember I said white, gray, black. Is my business vehicle 100% business? Well, I try to stop at the grocery store between going, from the office to my other office and so forth. Have I ever gone to a Rockies game? Sure. So I have a truck, which I just retired, and I'm going to talk about that. Just retired, and now I have a new truck, and I have a convertible. I will drive the convertible in the summer for business. So, but I don't write it off. I only write off my truck. You follow me? Because that's my personal vehicle. Okay. So there is some back and forth there. Just like, have I ever gone to Home Depot to pick up stuff for a personal project at the house? Absolutely. Okay. Now I'm kind of fortunate in the sense that I've got the convertible and I've got the old truck and the new truck. The new truck's 100% business. The old truck is 100% personal, and the convertible is 100% personal. Okay. I could actually now, what could I do? I could actually do 100% truck, 100% convertible, which would be fairly accurate. And I've got the truck, the other truck that I could drive for the personal use. Could do that. Right? So, how do you determine whether you want to do 70 cents a mile versus actual expense? It's how you treat vehicles. Okay? I bought the truck. It's an 03 Dodge Ram in 03 with 4,000 miles on it, because I don't buy new. So I bought that truck with 4,000 miles on it, and I knew I would keep that truck. It has 410,000 miles on it. But I did actual expenses, because what happens after year 5 on a vehicle? Starts nickel and diming you. So if you're like me, where you're going to drive a truck for 20 years before you finally go, okay, I'm going to break down and buy a new vehicle. And it's not new. It's a 2020. But it was 2020 for 35,000 with only 30,000 miles on it. I felt like I got a pretty good deal. If you're that person, go actual. If you're somebody who goes, as soon as I have to bring my car into the shop 3 times in 1 year, I'm done. I'm trading it in, I'm getting a new vehicle. Go mileage, because you're going to do better in mileage. Mileage will cover the cost of fuel, insurance, maintenance, repairs, car washes, interest if you're paying a loan, everything. It covers all of that in the end. Okay. Otherwise, if you're going to go actuals, then you're going to pay out of. So the reason I do 100% is so I have to figure it out, prorate it, and I can just look at what's my total mileage for the year. It was all business. Now you still have to show where you've been. So for example, I have a log at all times on my vehicle. It's called my calendar. So if you ever, and some of you may have seen my calendar in the past, this is my calendar. I track everything I do and everywhere I go. So right now I'm here, tax tactics. But guess what? Before that, I was up in Conifer, and then I headed down, and whoever I talked to, whatever I did, I color code, whether it's market center business, yellow is personal production, red is personal time. So all of this is tracked. I can go back to this log, and because I have beginning and ending mileage, I can figure it all out. Now, is there another way you could do it? Sure. What's another way you can do it? How many know about programs out there that are mileage logs? What's weird about that, though, is you got to shut those off if you get on a plane because it will track you to another place, and especially if it's not business. So it does track you everywhere. But you're required to keep a log. Well, Kevin, that's not a log. I understand that. Who can say the word contemporaneously correctly? Yeah, I'm not saying it right. Anyways, the IRS what that means is the IRS allows you to take information like this and go back and retroactively build your log. That's in the IRS code. Okay. So I'm not doing that, what our dads did. My dad would keep this log so he could divide it and track his mileage per gallon. Oh, it was this little detailed log that he would track. I can go back and reconstruct the log at that point, right? And because I have a home base with a home office, I'm always at 0. Yes. Yep. Again, do as I say, not as I do. This is another one where I kind of live in the gray, because I'm like, but I'm willing to take that risk where I might have to stay up 3 nights in a row working on a log because I got audited for my auto, for my business, and I have to provide one. So then I may have to go back and reconstruct that, but I'm allowed to. So it's not like I'm not allowed to. And if you do, I used it for a while. The problem I had is I go out of cell phone areas, and so it couldn't track perfectly. So I just go back to, I keep my calendar log, and I know where I've been, what I've done, and so forth. Okay, so does everybody understand the importance of that? And the key is if you're like me, I don't like investing in depreciable assets. I hate it. So I don't. I'd rather invest in real estate and other things that make money, not lose money in the long run. So, and by the way, it was the first quiet Cummins engine in that Dodge Ram, and today I could get 12,000 for it. Seriously, 12,000 with 410,000 miles on it. It's gone through 3 trannies, but the engine's just getting broken in. So now I'm driving an F-150 Blueberry. If you've seen me in my truck. It's not going to be my last truck, but it was a good deal. All right. Other deductions. How about gifts? Can we gift our clients? Is there a limitation? It's ridiculous. $25 per person per time, unless you do what? Unless you brand it. If you brand it, it's unlimited. And by the way, branding doesn't have to be sophisticated. Like I'll buy like welcome to your house, and on the back I'll hand with a marker that's permanent from your realtor extraordinaire, Kevin Wilson, and my phone number. Right? So it doesn't have to be over the top. But if you're giving out, so if you give out a $500 home warranty at closing, I don't call it a gift. I call it a cost of doing business. And that's different. I mean, I've bought more washers, dryers, refrigerators. I've had people haul stuff off. That's just a cost of doing business, right? It's not a gift. A gift is you bought them pizza. You bought them a 6-pack. And don't buy consumables. Buy something that has shelf life, right? Or buy something with shelf life and a consumable. But once they consume it, there's nothing left. If you buy something that's kind of attractive, then they're going to talk. People are going to come over and go, hey, where'd you get that sign? That's a cool sign. Oh, my realtor got that for me. That's different, right? You want something with shelf life. What else? What are education? Absolutely. But it needs to be approved. Like that's why none of these classes are free. I mean, they are free. They're not free. You didn't know you owed me. That's why these are free. But if you're paying for a class, I take that back. I have paid for classes that were not CE approved, i.e. Tom Ferry or, any of those. That's fine. Star Power, that's fine. You can write those off, but it needs to be something that's going to help you in your business. I was about to say industry specific, but if you go and pay for a tax class to help you in your business, absolutely. That's deductible. Okay. How about entertainment? Can you take somebody to a ball game? Yeah. Can you write off season tickets? No. Used to be able to do it. Used to be able to write off season tickets. Can't do that anymore. It's got to be specific. It's got to be one and done, one and done, one and done, one and done. So you can definitely take people to a game and you can write it off. You need to keep track of the 5 W's. Who, what, where, when, how much. Okay? How much. And pretty simple. You only get 50% of that as a deduction. Food, entertainment. Okay, you only get 50%. If you're traveling, you can write off travel food, but again, it's 50%. Okay, so you need to separate travel food from travel. Travel is renting a car, hotel. Travel food is the food you buy. Okay, and you can include alcohol in that too.
Kevin, how about if you have an event for?
Yeah, that's a tough one. Yeah.
I mean,
So here's the gray area.
That's marketing.
Yeah, there you go. That's the gray area. So I would say if you were talking to a Lily White, they're going to tell you you can only write 50% off. I would treat it just like what you did. It's marketing. And I'd write the whole thing off. And I'm willing to take that risk. If I have a $3,000 event and the IRS comes back in and reclassifies it as entertainment and food and wants 50% of it back, I'll deal with it. But I feel like it's justified to be promotional and marketing because that's the whole purpose of what you're trying to do. What else? What are some other deductions that you're thinking of? Signs, obvious. Business cards, obvious.
Charitable contributions in the business. Yeah.
No, as a matter of fact, Yeah, they've really, I don't know what the IRS has against churches and nonprofits and stuff, but it used to be that on a C corp you could write it off 100%. Now you can't. With a sub S, you can't write it. It's not a deduction at all, but it will flow through to your personal tax return. However, part of this last tax legislation, I believe that you can get a cash write-off of up to a certain dollar amount on the front page of your 1040 if you don't itemize. I think a lot of people are going to itemize now with these new tax changes. They're going to go back to itemizing because really, when they passed that tax legislation back in the day, 5 years ago, I guess it's not that far back. They thought that was going to crush a lot of nonprofits and charitable things because now before they would hey, you're going to get this great tax write-off, it's worthwhile, and then most people started doing the standard deduction because that's so high, and so they threw them a bone that they can write off up to a certain amount on the front page of the 1040 versus nothing at all. I will say that that's why I came up with the tax strategy, then donate every other year. So like just save it up and then do a big donation, and then you're not every 2 years, and then it's worthwhile at that point. I realize it throws a little monkey wrench into the charity, but it's better to get something every 2 years than nothing every year. And that's what was happening. What else? What other questions? What issues have you run into in your business or wondered about? Okay. Mhm. Two different businesses. So what you're going to have is your real estate business, and then you're going to have your Uber business. Most likely, I would recommend doing mileage as your deduction. Now, you cannot flip-flop back and forth. Once you decide what you're doing, you have to do that forever with that vehicle, and then until you trade it in or sell it and replace it, then you get a choice again on your next vehicle. And so you just have to, like, my behavior around my business vehicles really solidified in, I'm going to say, the late 90s. Before that, I was buying older vehicles with higher mileage on them, but I wasn't keeping them as long. And then I said, hey, and the reason I did that is I don't like car loans. I've never liked the car loans. I had one car loan straight out of high school into college, and I've never had a car loan since. But I couldn't afford a $20,000 vehicle in the early days. I had to go and buy a $3,500 vehicle or a $2,500 vehicle. Well, those are much older vehicles with 50, 60,000 miles on it, and they would break down pretty quickly. So I realized pretty quick on that for me, actual expenses made the most sense. If, on the other hand, you're somebody who, no, I have a car loan and I'm cool with that. That's just part of my monthly deal. And every 3-4 years you're turning it over, the mileage again is going to make the most sense. In your case, I think just because you're going to be racking up the miles, that it's going to make sense. You will actually keep two separate sets of income and expenses, one for your Uber. And by the way, I've got many brokers that do this, to supplement, and you do what you got to do to get by. I mean, I tell my kids all the time, you don't have a job, you go find a job. You work at Burger King. I don't care where you go. You ain't sitting on the couch doing nothing. You're going to go out and make it happen, right? Make it happen. And I think it's unfortunate. How old are you, if I may ask? Okay, I would say even younger generation than you, especially the COVID individuals that were teenagers or in college or college age. The work environment we have requires them to have 2 to 3 jobs. I mean, that's just that work environment. It's crazy. Every one of my kids, before they kind of solidified into a career, I think every one of them worked at a restaurant. Every one of them had a different day job. They were working 2, 3 jobs. I mean, that was just the way it was. My generation, we'd be like, that's insane. I work 60 hours of one job, but yeah, it'd just be 2 separate sets of, yep. And then obviously your mileage is going to take care of everything, right? Everything at that point. Another one for me that's controversial is does somebody have a question? Hey, whoever typed that in, just say something. Whoever.
That's me.
Okay, what did you
I
write?
just
Right.
I just said I'm here to represent the 26-year-olds with 3 jobs.
Yeah, it sucks because nobody wants to take you on full time. So in order to make the bill, pay the bills, you got to take on 2, 3 different jobs. And it's just it's that work environment until you're able to finally get that one. But hopefully it's real estate. Real estate's that career, and then it takes over everything. But you do what you got to do to pay your bills. Period. I totally get that. Like I had one who married into it, married into the family, and it's like, you don't have a job? Go get a job. Well, but I'm waiting for the job. I don't care. You go to McDonald's, I don't care. You're not going to sit on a couch and do nothing, or you can fill out your resumes and all that stuff when you get home from work. But you're going to work. You're not just going to wait for that perfect job. That's not going to happen. Not okay. Yes, yeah, it's going to be separate mileage, separate, but it should be easy. Uber tracks it anyways for you.
Yeah, I use the app too, because when you turn it off, it doesn't track it. Like sometimes I'll be in an area where so I'll turn it off to get back to another area and turn it back on.
Oh.
So I'm still technically.
Yeah, so you're going to want that other app.
I have that other
Okay.
app, but I haven't tracked any of my real estate mileage, so I should probably just go back.
You start tracking it. Yep. Because you have an office at home, you have an office here, which is a touchdown. Okay, and anything in between, right? Now, you're not going to leave the office and go to watch the Broncos play and then go home and say that was business. Okay, so you got to use practicality. However, you leave the office on your way home, you stop at King Soopers, pick up the groceries, and then you go home. I'm cool with that being complete business.
My house, I take my son to school and then I take the office.
I would consider that business. It's just on the way. Sorry, guys, I got to stand. I think my butt went to sleep. Yeah, I would consider that. 100% business. Now, when I say that, I'm not saying you got in your car, you drove an hour to some special school that's in Fort Collins, and then you came back. That's different. But you went a little way out of your way, and then you round. Yes, I'm fine with that. Yeah, I'm fine with that. And you're not going to run into problems on an audit with that. I've dealt with it. So, what else? What are some other expenses that you question? Jim, what are some of the exotic expenses you're writing off?
Real quick though, before he answers.
Yeah, go ahead, Greg.
A lot of input. Do you have any documentation or anything that I can personally hold on to and refer back to? Because I can't remember all this.
No, I would say come to my class every year. The other thing I would say is this: hire somebody. And I'm not looking for clients. I know every year you guys are like, oh, Kevin. No, I'm firing clients on a regular basis. You don't pay your bill. You're late on your bill. You're gone. But no, I would recommend. The expense part of it is pretty straightforward. Before you go into the entity, that you're gonna have to hire somebody to set up the entity anyways. And you're more than welcome to call me, contact me. Many of you have, where you've had questions. Hey Kevin, do you think this makes sense for me now? And I'll talk to you about it on a one-on-one basis. I try not to pull too many people's one-on-ones in public. Not everybody wants to share. Most of us don't want to talk about it. That's when I went bald. I went bald because I had 3 years of tax returns that were audited, and I actually had to hire. I'll tell you what happened. It was actually late '80s, early '90s, but it incentivized me to go back and get my master's degree in taxation. I was hooked up with the guy that because I had an accounting degree, said, "Hey, you want to do some taxes on the side?" Because at the time I owned a Chick-fil-A. That was like my first thing out of college was Chick-fil-A. And so I was doing it on the side because at that time the salary was $24,000 a year plus you split the profits. That was the deal. And my Chick-fil-A was in Cinderella City Mall.
I remember that.
You know where the Cinderella City Mall was?
Oh yeah.
Say that again?
I do.
Yeah, and it's no longer there. So I was the last operator of that Chick-fil-A, and I was like, this ain't working. And the guy I was hooked up with, I didn't realize, was under investigation by the IRS for tax evasion on a personal level. And so, I was, at that time, we did tax returns in pencil, and then you would transcribe it into pen, and then you would turn it in, unlike, today with our computer programs. And so because I was working with him, even though I wasn't an employee, I got sucked into 3 years of audit at my house. Field agent came out. They call them field agents. Luckily, they didn't have a badge and a gun, because if they come with a badge and a gun, not good. You're probably going to jail. But anyhow, yeah, that's when I lost my hair, and but it also charted my course for the next few years. I was commuting on a motorcycle to CU to finish my master's degree. Took my CPA test, and the rest is history, because I'm a real estate broker. Hey, real estate is a second career for everybody. All of us did something else first. All right. Anything else? Anybody else have anything?
Yeah, Kevin,
Go ahead.
I found out that, but if you have a rental, that helps too, but don't be afraid to deduct a lot of stuff in this real estate business, because you can. And I found that as long as you pay a fair share of taxes, you're not going to get audited. I think the ones that get audited, if you don't pay taxes, or
knock on some wood, buddy.
that's right. Or it's obvious that you're paying very little on a large amount of money. But if you're paying taxes that's reasonable, my feeling is that you're not going to get audited. Okay, and then
I don't disagree.
Okay, yeah, and so we've been pretty fortunate, and don't forget, a lot of expenses could be the cost of sale. If you have a rental, you could deduct a lot of stuff on that. But I remember I got a brochure here on the secret of how to make money, and Kevin, you brought this up, but I got a brochure of the secret to making money, and it's really easy. You open it up.
Go to work. Go to work.
That's brilliant.
I have one motto: just do it. Don't plan it. Don't think about it. Just do it. Go do it. Stop talking about it. Stop sharing it. Just go do it. All right, guys, that's all I got. Told you it'd be about an hour and a half.
Thank you.
You're welcome. If you have any questions, let me know. Otherwise, have a great day. Hopefully this was not an hour and a half of your life that you'll never get back. Hopefully you got something from it.
Oh, I did.
Yep.
All right. Bye.
Thanks, Kevin.
You're welcome. All right. Yeah, I mean, the other one, I was like, man, I wouldn't work with that person, but that person, yeah, they're pretty aggressive. You're welcome. You're welcome. Ugh. Yeah, I don't see the off switch. Oh, good. I'm glad you remembered that. I would have just drove off with it.